Dividend investing strategy simply involves buying stocks or funds that pays out a high amount of dividends so that we can get this lovely passive income from our investments. But what if I told you that those dividends don't really matter when it comes to the total level of your wealth? Well, to know why and why I am not a dividend investor, keep watching. Hi guys, I hope you're all doing well. So remember that the total return of an investment is equal to capital return plus income return. Capital return is the change in price that you see every day. The income return is the dividend yield that you get from those investments, such as stocks or funds. When it comes to dividend investors, they would heavily focus on this income component of the total return formula. So they would look for company stocks that pays out a very high dividend yield. The dividend yield should be higher than the overall market. So why do many investors pick up this dividend investing strategy and why so many people love it? I would put this into three main categories so I can explain why I don't do it. Firstly, many investors invest in dividend paying companies because they do really need that income to pay for stuff like bills and mortgages. It is simply a source of income. As you get closer to retirement, investment professionals would tell you to include more of your money into bonds than stocks. And this is because bonds pay out a fixed amount of income so that you know exactly how much money you are getting. The same thing is happening with dividend paying stocks. However, unlike bonds, when you're investing your money into dividend paying stocks, you're also getting some sort of growth in your initial capital. Secondly is the reason around stability. Since high dividend paying companies are generally more matured, you can easily predict their dividend return because they make that information readily available to you way before they pay out those dividends. This makes the total return formula that we just saw more stable because of those dividend components. This is famously known as birds in hand theory, where people prefer to have most part of their investment return now in dividends than waiting for that money to grow in the future through investing in growth stocks. And the third reason is around the psychological factor. When dividends are paid out in cash, a lot of people would look at it as free money or like a gift from the company because you are investing with them. However, this is not true. Dividends should not be seen as free money because when a company pays out a dividend, its price generally falls by the same amount. The company is simply reducing their own value by paying out a part of their earnings to you. This makes the overall value of the company drop. The decline may not be one for one, but it would be very similar to the amount of dividends that they have paid out. So in fact, the total true return should pretty much stay the same whether the company pays out a dividend or not. Having said that, here is why dividend payments don't really matter. Let's welcome the dividend irrelevance theory proposed by Miller and Modigliani in 1961. The main basis of the theory is that issuing dividends does not increase a company's potential profitability. And when the company's profit is not increasing, well, why are you even investing with them? The theorists provide quite a simple reasoning behind why this is the case. Because if you think about it, dividends are essentially a cost for the company. Because dividends are paid out from the company's earnings. And companies are doing this by foregoing their own growth. So if the companies don't use this money to reinvest in themselves, how else are they going to grow? What the theorists also argue is that as an investor, if you are rationally thinking, it should not matter to you whether your investment pays a dividend or not, because it should not affect your overall level of wealth. It will only affect the form of your wealth. Here is an example. Investor X invests in a company A, while investor Y invests in a company B. Company A has a current market price of £100 per share, and it pays out a dividend of £5 per share. Company B also has a current market price of £100 per share, but pays out no dividend at all. What happens to these investors' wealth after company A pays out a dividend? On day one, both investor X and Y has wealth of £100 each. On day two, A pays out dividend, so on X investor's account, they will have £5 in dividends and the stock price will go down to 95. And in investor Y's account, they will also have a total level of wealth of £100. So as you can see, you effectively have the same amount of wealth, only the type of wealth you have changed. Now you must be wondering why a company's stock price drops right after it pays out a dividend. This is very much down to market efficiency and investor reaction. Since dividend payments are announced well before, a lot of investors would naturally pile on stocks that is going to pay out dividends soon. And so once the dividends are paid out, it no longer forms part of the company's earnings, which reduces the value of the company. And so the price of that stock also falls by a similar amount. It accounts for the fact that new investors are not eligible to receive those dividend payments and are therefore unwilling to pay a premium or a higher price for that company stock. This theory has been talked about and tested across various literature. I'm going to share some links to academic literature talking about these theories. Feel free to read them whenever you like. Coming back to the theory. So although dividends itself might be irrelevant, theorist realizes that the form of wealth would matter to a lot of investors. I mean, a lot of investors would actually prefer to have some cash or passive income in their portfolio. So what these theorists have proposed is that if you are unhappy with the fact that you are not getting a dividend, or you got less dividend that you really wanted, then you can make up for it by selling some of your shares. This is known as homemade dividends. Selling shares to give yourself a dividend is same as getting those dividends directly from the company. However, many investors, they would not really do that. Behavioral economics describes it as a cognitive bias called mental accounting. Investors look at dividends paid out by companies as free money. So most of us, we would happily spend those £1,000 of dividends that were paid out by the company, but won't do the same when it comes down to dipping into our own capital by selling shares. As you may have already picked up, this theory is riddled with flaws. And that is because it is based on a lot of different assumptions, like corporations and individuals pay no taxes on their income level. Although in reality, dividend income taxes are generally higher than capital gains taxes. Secondly, the theory assumes that there is a free flow of information out there. So all information will be readily available, and so stock prices won't be impacted by anything else than simply these dividend payments. And finally, the theory also assumes no agency fees or transaction cost. It pretends that the firm or the company can issue out new stocks to raise more money for their project, while in reality this is not true. It also assumes that we, the investors, don't have to pay any cost to buy and sell shares, which helps with the homemade dividend idea. However, that is also not true. Leaving the theory behind, I wanted to give some practical reasoning behind why I personally don't invest in high dividend paying companies. Firstly, I still have a longer investment time horizon, and so I don't really need those incomes right now. I would much rather let my money grow faster over time. Here is an example of FTSE 350 index. When you look over the history, although dividend part of the total return remains stable, it really is the capital return that seemed to drive most of its performance. When I talk about pure dividend investing, I'm referring to those companies that have high dividend yield or those that pays out most of their dividends to their shareholders. Take FTSE 350 High Yield Index as an proxy. These companies are generally more matured and stable, and because they don't have or need a lot of money to reinvest in themselves, they pay out a big chunk of their profit to us, the shareholders. And so you don't generally get a high capital returns from them compared to other index like FTSE 350. This is not to be confused with the fact that I don't invest in any dividend paying companies at all. I do, however, I'm very careful in picking those companies. I will only invest in dividend-paying companies that's got a very low payout ratio. A payout ratio is a portion of the company's earnings that is paid out as dividends to their shareholders. By low, I'm talking about a payout ratio of less than 50%, because I don't want those companies to pay out most of their earnings or profit to me right now. I would much rather want them to invest this money back into the company so that they can grow faster, which should be reflected in their capital return. So having a low payout ratio would also mean that the dividend yield number will also be pretty low, because dividend yield is equal to the payout ratio over the PE ratio. So higher the payout ratio, higher the dividend yield. For me, I would look at dividend yield to be pretty low, like 2% or less. This highlights to me that it is a steady growing company and still has plenty of growth potential. And finally, although I'm not a dividend investor right now, I will be rebalancing my portfolio to be tilted towards more dividend paying companies as I approach my retirement age. And remember, different people would want to retire at different times. So this is not to say that don't, become a dividend investor because you're 40 or you're 30, because your plan for retirement could be 40 or 30. But for me, I am happy to wait for more years so that my money can grow faster than start to dip into them through passive incomes and dividends. I know that this is a pretty touchy subject, but I would love to know whether you consider yourself a dividend investor and why. Do let me know in the comment section below. And until next time, look after yourself and your money.